5 years ago, Kevin and Brian both achieved a net worth of $1 million. Kevin used the million as collateral to borrow $5 million, buying up a massive portfolio of commercial real estate. Financial influencers praised the extreme use of leverage. Brian refused to borrow. The million was quietly fractured into 3 equal, debt-free segments. When lending requirements tightened and commercial tenants defaulted, the banks called in Kevin's loans. Kevin lost everything in a matter of weeks. Brian remained completely debt-free, liquid, and holding cash-flowing assets. The secret was not a better work ethic. The secret was the 777 money rule, a 2,000-year-old defense mechanism against the modern fractional reserve banking system. The 777 rule, often referenced by historians as the ancient Talmudic wealth formula, is a 2,000-year-old strategy designed to make financial ruin virtually impossible. The rule is simple, ruthless, and mathematically bulletproof. Total wealth must always be divided into 3 equal thirds. First, 1/3 is deployed into land or real estate. These are hard, tangible assets that hold intrinsic value regardless of what the underlying currency does. Second, 1/3 is deployed into business or merchandise. These are active, cash-flowing investments that generate daily income and keep capital moving. Third, 1/3 is kept in pure, liquid cash. This acts as an absolute defense against emergencies and provides the tactical ammunition required to buy up cheap assets when the rest of the market is panicking. The modern banking system requires total participation to function. Financial institutions demand that capital either be fully invested in their products to extract management fees or fully drowned in their debt to extract interest payments. The 777 split removes this institutional leverage entirely. By diversifying not just across asset classes, but across the fundamental nature of the capital itself, an investor builds a fortress that cannot be breached by inflation, market crashes, or banking failures. The first third of the 777 rule demands ownership of land or real estate. This is the anchor. Modern financial advice often pushes retail investors heavily into paper assets, stocks, bonds, mutual funds. Paper assets are entirely reliant on the continued success of the underlying corporations and the stability of the financial system itself. If the system fractures, paper wealth evaporates in seconds. Land operates under a different law of physics. The supply of land is entirely finite. No central bank can print more acreage. No government can suddenly issue new plots of earth to cover a deficit. Because of this absolute scarcity, land acts as the ultimate sponge for inflation. When governments devalue the currency by printing more money, the nominal price of hard assets inevitably skyrockets. Holding 1/3 of total wealth in physical dirt ensures that a massive portion of the portfolio is completely immunized against fiat currency collapse. Even if the stock market goes to zero, the land remains. It provides physical utility, agricultural potential, or development opportunity. In historical periods of hyperinflation, the individuals who held paper lost generational wealth. The individuals who held land simply adjusted their prices. The anchor ensures that a foundation of value always remains intact regardless of macroeconomic chaos. The second third of the formula is dedicated to business or merchandise. This is the engine. Land is an excellent preserver of wealth, but it is notoriously illiquid and often fails to produce immediate, high-velocity cash flow. A financial fortress cannot simply defend, it must aggressively produce. Deploying capital into a cash-flowing business provides the daily, weekly, and monthly income required to sustain life and fund further expansion. This bucket is the active component of the portfolio. It requires management, oversight, and strategic execution. Whether it is a local service business, a logistics company, or raw inventory intended for resale, the purpose of this third is to generate yield. More importantly, a privately owned business provides absolute control over margins. When inflation strikes, a bondholder is trapped with a fixed yield that buys less every single day. A business owner simply raises the prices of goods and services to match the exact rate of inflation. The engine ensures that the portfolio is never stagnant, constantly pumping fresh capital into the ecosystem to replenish reserves or acquire more land. The final third of the 777 rule is the most controversial in modern finance: liquid cash. This is the shield. Traditional financial advisors view uninvested cash as a severe liability. The common narrative dictates that inflation eats cash. Therefore, every single dollar must be constantly invested in the market. This narrative is a trap designed to keep capital trapped within the banking apparatus. Holding 1/3 of total net worth in pure liquidity serves two vital, non-negotiable functions. First, it guarantees survival during a severe liquidity crisis. When recessions hit, credit markets freeze, banks stop lending, credit lines are suddenly closed, and refinancing becomes impossible. Individuals heavily leveraged in real estate or fully exposed to the stock market are often forced to sell assets at a massive loss simply to cover daily liabilities. A massive cash reserve prevents forced liquidation. It ensures that bills are paid, payroll is met, and life continues without interruption, completely independent of banking approvals. Second, liquidity is the ultimate offensive weapon during a financial crash. When markets collapse, assets go on sale. Real estate is foreclosed upon, businesses face bankruptcy, and stocks trade at severe discounts. The individual holding pure cash is the only entity capable of stepping into the carnage and acquiring premium assets for pennies on the dollar. The shield ensures that while others are losing generational wealth, the individual is systematically acquiring it. The genius of the 777 rule lies not in maximizing returns during a bull market, but in mathematically preventing ruin during a bear market. Traditional portfolios optimize for the best-case scenario. The ancient formula optimizes for the worst-case scenario. Consider a macroeconomic crisis where the stock market drops 50% and real estate values plummet. An individual fully invested in those markets sees net worth cut in half. Panic sets in. However, an individual operating on the 777 rule experiences the exact same crisis entirely differently. The real estate portion may temporarily lose paper value, but it is not sold, so the loss is not realized. The business portion may see a dip in revenue, but it continues to generate baseline cash flow. The liquid cash portion suddenly gains massive purchasing power relative to the collapsed asset prices. Because the capital is fractured into three completely non-correlated buckets, a disaster in one sector cannot mathematically destroy the whole. The fortress holds. The system relies on absolute equilibrium. When profits from the business overflow, the excess is funneled into buying more land or bolstering the reserves. When cash reserves grow too large, they're deployed to acquire more merchandise or expand the business. It's a self-balancing, self-healing financial ecosystem that completely bypasses Wall Street. The traditional banking model relies on a concept called fractional reserve banking. Banks take retail deposits, keep a tiny fraction in the vault, and lend the rest out at a higher interest rate. The system requires massive, constant deposits from the public to survive. Alternatively, banks generate massive revenue by issuing debt, mortgages, auto loans, business credit. The 777 rule starves the beast on both ends. By holding hard assets like land directly, capital is removed from the bank's exploitable deposit pool. By operating cash-flowing businesses that self-fund through internal revenue, the reliance on commercial bank loans is eliminated. By holding a massive personal reserve of liquid cash, the individual essentially becomes an independent central bank. The need for high-interest credit cards or emergency personal loans vanishes. Financial institutions spend billions of dollars annually on marketing to convince the public that wealth can only be achieved through complex financial products, managed funds, and strategic debt. They despise the ancient three-part formula because it creates financially sovereign individuals. A financially sovereign individual cannot be charged management fees, cannot be trapped by interest rates, and cannot be forced into panic selling. Implementing this ancient framework in the modern era requires extreme discipline and a complete rejection of mainstream financial advice. It begins with an aggressive audit of total net worth. Calculate the exact value of all assets, liabilities, and liquid reserves. The overwhelming majority of individuals will find their capital dangerously skewed, often 90% tied up in a primary residence or 100% exposed to paper assets in a retirement account. Rebalancing into the three absolute thirds takes time. It requires liquidating underperforming paper assets to build the cash shield. It requires aggressively paying down debt to establish pure equity in hard land. It requires launching or acquiring a cash-generating vehicle to serve as the engine. The transition is deliberately slow and entirely unglamorous. There are no overnight returns. There are no flashy screenshots of explosive stock gains. There is only the quiet, methodical construction of a financial fortress. The 777 rule is not a get-rich-quick scheme. It is a stay-rich forever mathematical certainty.